The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to Scorebox Europe. I'm Steve Sedgwick with Karen Cho and Ben Boulos, who is live in Oslo. These are your headlines. The US President Donald Trump is reportedly not happy with Iran's latest peace proposal, which insists that nuclear talks be postponed until the war ends. Meanwhile, the German Chancellor Friedrich Merz launches a fierce critique of Trump's Iran strategy.
I can't tell what strategic exit the Americans are pursuing, especially since the Iranians are obviously negotiating very skillfully, or perhaps very skillfully refusing to negotiate. An entire nation is being humiliated by the Iranian leadership.
A tough pill to swallow for Novartis as net sales come in short of expectations. The pharma giant blaming the impact of generic drugs for a double-digit percentage decline in operating profit. Be hearing from the CEO, Vas Narasimhan, that is at 7:30 London time.
Norway's finance minister and former NATO chief Jens Stoltenberg tells CNBC that rising oil prices may have boosted the country's economy, but he pushes back at suggestions it is better off because of global conflicts.
We will have some increased oil and gas revenues because the oil price is going up, but on the other hand, other parts of our economy may suffer if exports go down because economic global growth goes down.
We'll also hear from the NBIM Fund CEO, Nicolai Tangen, this morning.
It's a funny old stage for Barclays. Barclays, Karen's going to do it at the moment for BP, because everyone assumes, and you see it in the stock market moves every day, when the oil price goes up, it's great for the majors, it's great for the refiners, it's great for the oilfield services companies. But only if you can get the product out of the ground, refined, and to the customer. I know that sounds a really obvious thing to say, but that is the problem that, of course, all the Middle Eastern NOCs, national oil companies, are facing, and the international IOCs are facing if they are in that region, which, of course, we know has some of the most bountiful reserves on the planet. So, yes, BP shares have rallied aggressively because their underlying commodities, oil and gas, are rallying aggressively. Look at that, 58% higher, but only if you can get the product out the ground. This is a very important line. BP expects underlying upstream production to be broadly flat compared with 2025, but they are talking about potentially lower upstream production, lower compared with the first quarter because of all the things that we've talked about there. So in the second quarter, upstream production can be lower compared with first quarter because it's just tough to get product out as well, isn't it? So the figure you're looking for, by the way, is a very big figure. It is a $3.2 billion net income figure in the first quarter adjusted, compared with the estimate of 2.6. So a big beat there as well. The divvy, for everyone who cares about these things, I know you do, you should do anyway, it's your income, $0.083 per share as well, and the net income figure at $3.84 billion US dollars. They made further progress towards their 2027 targets, but of course you have Albert Manifold, the chair, and you have a new CEO as well. So don't be surprised if over the next quarter or so you see a lot more updates on the strategy as well. Every CEO comes in and we know plans to just stamp their own brand on the company as well. But just one or two more lines. In its customer business, it expects, compared to the first quarter, second quarter, just seasonally higher volumes to be more than offset by a lower midstream result as well. So whilst it is obvious that higher prices benefit oil companies, there you go, there's your rocket science for the day. The fact of the matter is getting product out, getting it turned around into usable product and getting it shipped to customer, that is what we're all facing as a problem, whether you're an IOC or an NOC or what have you. In the meantime, I'm expecting solid results from Barclays.
Yeah, we do actually. The market was looking for a number above about £8.12 billion in revenue for a sign of momentum. We're at £8.16 billion. So that first quarter of revenue rolling through at a decent clip. The pre-tax profit £2.81 billion. And if you consider the EPS, 14.1 on a net profit of coming through at 1.93 billion. The Other big points here. It's around the share buyback, the returns. Investors have been closely looking for that to be stronger. There was a big return program last year and this year. Now we've had fresh news that they will initiate a share buyback of up to £500 million after the ongoing £1 billion share buyback is completed. And as far as the eye can see, from 26 to 2028, it plans to return greater than £15 billion of capital to shareholders. So that is a truckload of returns. In terms of the ROTE, it is talking about the outlook here and also what the ROTE is to date. For first quarter 2026 ROTE of 13.5%, which does look decent. It looks as though that's been some form of an improvement, and they're targeting by 2028 greater than 14% on that metric. But here's some caveats now. So there's some provisioning and there's some credit charges. So the market will also be looking for that given the cycle in. Some of this is legacy. Increased its provisioning by £105 million for the first quarter for the FCA motor finance redress. So the total now is 430 million for that particular saga. In terms of what they're looking at, though, there is also a one-off charge, an impairment in the quarter. So a bit more clarity required on that at this point. But I think the focus on these returns today, planned return at least 10 billion of capital to shareholders between 2024 and 2026. That is key at this stage. We're going to be hearing from the Barclays CEO, CS Venkatesh Krishnan. That is later on today. Venkat coming away. The interview is coming at 3:10 p.m. London time. And let me take you to what we're seeing on US markets in session yesterday. Those records again rolling through for the S&P 500 and the Nasdaq, much stronger, as you can see, in terms of the overall level of these market indices. Despite all the uncertainties around the war in Iran, we still have those fresh intraday and record close on the market. What's powering it again is technology names. Nvidia to the upside. Investors again switching out of some tech names back into semiconductor names. That is supporting what you're seeing on those two boards in particular. The Dow has showed an element of reversal, though, in the last couple of sessions. It was its third negative session in a row. So what's dragging on it? The likes of McDonald's in session yesterday. I want to take you to the Asian markets. Big news out of that part of the world has been the Bank of Japan. It held rates steady, but you had 3 of its 9-member board proposing rate hikes. So the market is now looking at increasingly hawkish BOJ as it too battles some of the headwinds around the war in Iran and those inflationary pressures. June seems to be the time frame some market participants are looking at for a rate hike. That is similar timing to the ECB. So maybe a June hiking story from a number of central banks. But you can see the Japanese stock market is down today as a result. Hong Kong stocks down 1% too. Shanghai reversing. It's just the Kospi showing us that strong hand thanks to the technology story. And let me take you to European markets. Again, that fatigue we've witnessed in recent trades was evident yesterday. We had elements of green in the morning trade giving way to selling by the afternoon session. We closed out down 5th negative session out of 6 for the Stock 600, down about 1/3%. And really right across most of the major markets, it was trimming of some of the positions. 2/10 down, for instance, on the German stock market. This morning, we are seeing 50 futures inclined higher, but very slim range. FTSE futures are heading south and no change on the DAX. So it is not exactly a position of strength. The US futures early on, this is how we are setting up for the day stateside. Again, it looks cautious at this hour. Let's get to Tina Lee, who is the CEO of Citi UK. Tina, thank you so much for joining us today.
Morning, Karen.
We're just talking about all the big moving pieces. We still have the impasse in the Middle East. How are you thinking about how investors need to be weighing up the factors right now, given we're also trading at record stateside?
Absolutely. Well, look, I mean, the markets have actually performed pretty well if you sort of think about it over the last quarter or so. And whilst we have seen, of course, sell-offs in terms of certain government bond yields, we've seen equity markets at pretty much all-time highs. You know, so what we're seeing is markets are performing in an orderly way. Of course, we've had clients that are needing to sort of hedge their exposure, particularly over the last 3 or 4 months. But otherwise, things have actually been going pretty well.
Having sat through pages and pages of macroeconomic outlooks in the last 2 weeks, there were so many risks fleshed out, from some sort of inflation problem to growth shock to stagflation to private credit issues to too much exuberance and higher prices in AI causing some sort of backlash for financial markets. What's most concerning for you?
So, what I would say is that, of course, with the conflict, we still don't know at this point the depth and the length of the conflict. So it's really around how long it lasts. If we think that actually it will probably last for the rest of this year and beyond, of course, what does that mean in terms of those higher energy prices?
That's not a benign scenario, just to be clear.
No, absolutely. But at the same time, we've had Brent crude trading around to the $100, there or thereabouts. If we see that spike to 120, 150, of course, that's a very different scenario. But certainly that's not our base case at Citi. We expect that actually growth to remain fairly resilient for 2026. We're estimating about 2.7%. We have adjusted that down, probably about 20 basis points in the last month or so. But certainly a recessionary environment is not our base case.
Tina, I was chatting to you very briefly off air, and we were talking about some CEOs who I had a conversation with off camera last week, and the US CEOs amongst them were so stunningly bullish. I was taken aback. Now, I always get wonderful confidence, as we all do, from our American colleagues. And you know this. We all work for Americans. We know how incredibly ebullient they are. But even more so, despite everything. And I want to know whether that's hyperbole, whether it's irrational exuberance, or actually do you believe, despite all the tariff stuff, despite all the concerns about cycles, valuations, and what's going on with this war as well, what is the bedrock of that confidence?
Look, the resiliency of the US economy is phenomenal. When we sort of think about the size of the market and the opportunity, in spite of some of the macro headwinds that we've seen over the last 3 or 4 months, if you think about the underlying, of course, you mentioned AI. AI has been a massive growth spurt. We're in the middle of the most significant investment cycle in a generation. So whilst some of the macro and the geopolitics, is something we clearly have to keep an eye on. When we think about the opportunity as a result of artificial intelligence, when we think about data infrastructure, we think about energy, actually there is a lot to play for. So when we speak to CEOs, they're just as bullish in terms of opportunity for their own companies. And also when opportunities make deep strategic sense, what you've seen over the last quarter is, in spite of those headwinds, we've seen record M&A volumes.
Tina, everything you said, being an old cynic that I am, I could turn around and say that is a reason to be concerned. The energy required for this boom, the jobs not required for this boom, the cost, AI, those two, the cost of the war on Americans as well, the cost of the war on American consumers as well. And the fact, and I'll just chuck this one in before you answer as well, that there are certain indicators that have served Warren Buffett very, very well that are flashing bright red at the moment in terms of the value of the US economy compared with the value of the stock market associated with that AI boom. None of those things to be concerned about?
Look, I think that what there is there continues to be an enormous amount of opportunity to do business. So whenever we speak to multinational companies, North America remains a key export market. It just does. I was in China last month, and every single Chinese company, their number one target in terms of an export market is North America. So, so whilst that is something absolutely to consider, at the same time, the size and the scale of that market makes it something that you can't ignore.
Tina, I'm going to have one more go. Every one of those Chinese companies, no, not everyone, I'm sure a vast number of those Chinese companies are exporting high-end goods now, or higher quality goods than perhaps historically they might have done. They are competing with the United States and the West and Israel and everywhere, Middle East, on higher-end goods now. Great products, whether it be technologically very industrial products such as cars, such as solar, or actually on the AI side of things as well. Why shouldn't the Chinese be eating the Americans and Europeans' lunch?
Well, what we see is actually the flows are very much two-way. So when we sort of think about those trade corridors, it's actually very vibrant with international companies looking to expand into China, and Chinese companies looking to expand into the UK, into Europe, and of course into North America. So it's not a one-way. It's not one-way traffic at all. Now, of course, when it comes to areas like advanced robotics, manufacturing. Of course, the Chinese have made tremendous progress, whilst at the same time, there's real opportunity in terms of collaboration in areas like clean energy, in battery production, for example, or indeed in financial services, where since the beginning of the year, we did see obviously the trade mission that the government made to China, and there is now the UK-China Financial Working Group. So actually the ability to collaborate, with markets such as China, I think is a real opportunity for the UK.
I want to just circle back to some of the concerns in the marketplace around AI, because for me, this is still an enormous one. We're hearing that it's like rocket fuel that's been poured into the data center area at this point. We could see it in terms of some of the market activity. There's a piece in the Wall Street Journal today that I urge our viewers to read because it is fascinating. It points to OpenAI missing internal goals of reaching 1 billion active users. It talks about yearly revenue targets being missed. It talks about defection rates among subscribers. And then the CFO has been quoted talking about the company maybe not being able to meet future computing contracts. If we think about $1 trillion worth of contracts inked in 2025 alone, that stretches from NVIDIA to Oracle to AMD to Amazon to CoreWeave. And if there's a problem in future, it does beg the question of whether we're looking at some sort of a bubble and whether there's exposure risk for big banks like Citi. How cautious are you around digestion issues of debt, whether it's a big placement like Oracle coming to the market, whether it's exposure to some of these other big companies or companies that are connected in that circular chain, which we've all been reporting on that could be an issue. How cautious are you about all this?
So look, resilience is something which is very important to large banks, including Citi, which means that we're never over-reliant upon one supplier. So what that means is that, of course, we deal with many of these large tech companies, some of the ones which you've just mentioned. So it's really around making sure that we're able to deliver our own services, which means not being over-reliant upon one entity.
Even if it's the only growth story in town and it's some of the biggest companies now on the planet, you're still cautious about being too exposed.
But don't forget that AI is going to not only transform financial services, but it's going to transform every single sector. So we're seeing that already at Citi. We know that actually financial services are going to look very different in 7 years time, because of the streamlining of processes, the way that we're managing our underwriting risk. We're using AI tools to free up capacity of our IT staff. So all of this is happening at pace. So whilst I think there has been, a very large focus in terms of whether it's, debt borrowings or indeed activity in the market, at the same time, the opportunity is one I think that all institutions, have to grasp with both hands.
Tina, you are one of the most influential people in British business, or certainly British financial business as well. And when I go down to the wharf now, it's buzzing. I know Shobi would love me to say that, but it is absolutely buzzing down there. And I was down there for a little event on Sunday as well, which I don't like to talk about. But the fact of the matter is, there are parts of the UK economy that, in spite of the downbeat rhetoric and the downgrading by the IMF of our growth expectations, are buzzing. Is the government in danger of spoiling that as well and ruining what are the still very, very good parts of the UK economy?
Look, the UK has always been, it has been powered also by London and the South East. I think all the work that's been done around sort of trying to really build, those other areas, for us, Belfast is a great success story. We've got 4,000 people in Belfast, but that's been built up over 20 years. It's not something that can change overnight. You do need long-term commitment to build up the skills, build up all the way through from colleges, from universities, all the way through to actually having the ability to attract and retain senior staff in locations outside London and the South East. So, it's something which every single government needs to build on. To your point, Steve, of course, there are brilliant areas outside London and the South East when you think about what's happening in Scotland, in Manchester, in Leeds, or indeed in Belfast.
I hear you. I hear you, but I see government after government look at, look, there's your sector. We'll grab a few more quid off that one. Look, there's the financial sector. There's Tina Lee. She earns too much money. I'll have a few quid off her as well. I'm sick of it. I'm sick of it, of the politics of envy, when actually these great growth, and I hear what you're saying about the rest of the country, it's brilliant, but the growth driver of the UK is still financial services, or it's the number one, has been. Why are politicians not listening to you and other senior businessmen and women about the benefits rather than just milking it for every single penny?
Well, we continue to advocate for the UK needing to maintain its position in terms of being globally competitive on tax. We know that governments have lots of different priorities. We will continue to do that. We think that it's absolutely key in our ability to attract talent into the UK, but also retain talent in the UK that's grown up here, that we want to actually make sure that they provide all the benefit to the UK country rather than, of course, elsewhere. So, we continue to do that. So, it's, I think it's an important part, but it's not everything.
Got to leave it there. Do you need a bigger office now that the rivals are going to have a big one down next to you?
We have a fabulous city tower, which is going to be ready this summer.
It's a big one they're building.
Yeah, we've got a big one too.
Tina, lovely to see you. Tina Lee, CEO of Citi UK.
Coming up on the show, Friedrich Merz hits out at President Trump over the war in Iran, plus a hawkish hold from the Bank of Japan as policymakers grapple with inflation pressures. And we're going to check on the market outlook with Nikolai Tanger, the CEO of Norges Bank Investment Management, that is coming up at 7:45 London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's Miss Jo Malone, CBE.
I started that first business of skincare. That's when I knew that I was in charge of my own life. And that's when the entrepreneur really, although I didn't know what the word entrepreneur meant, that's when the entrepreneur really took hold.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this. Who do you listen to in life? Do you listen to your enemies or do you listen to your friends? Hopefully, we all listen to our friends because they're the ones with the good advice. And if they're good enough friends, they tell you how it is regardless. Friedrich Merz is a stern Atlanticist. He's a friend of the Americans. He's not anti-American. But he's now criticising Washington pretty aggressively over the war, saying that the US is, quote, being humiliated. Listen to this. I'll come to the buy in a few moments' time, but I want to get the points to you before we listen to the man. The Iranians are clearly stronger than expected. The Americans have no truly convincing strategy in negotiations either, he said. He said the problem with a conference like this is always the same. You don't just have to get in, you've got to get out as well. I mean, this is a friend telling America this as well. We saw very painfully in Afghanistan 20 years ago. We saw it elsewhere as well. He's basically saying at the moment, and this is the key line, at the moment, I do not see what strategic exit the Americans will choose, especially when the Iranians are clearly negotiating very skillfully, or wait for this, or very skillfully not negotiating at all. Let's listen to the German leader.
Ich erkenne im Augenblick nicht, welche.
At the moment, I can't tell what strategic exit the Americans are pursuing, especially since the Iranians are obviously negotiating very skillfully, or perhaps very skillfully refusing to negotiate, and then letting the Americans travel to Islamabad, only to send them back without any results. An entire nation is being humiliated by the Iranian leadership, especially by these so-called revolutionary guards.
The entire nation, he's talking about the United States, is being humiliated by the Iranian leadership, particularly by the so-called Revolutionary Guards. And that's a friend talking to America. US President Donald Trump is reportedly not satisfied with Iran's latest proposal to end the war and reopen the Strait of Hormuz, as negotiations between Washington and Tehran appear largely stalled. Dan joins us with more. Dan, interesting. I thought it was an interesting carrot dangled by the Iranians, but just tell us more about the reception.
Well, Steve, Tehran put forward a new formal offer overnight, but the White House is already sounding pretty skeptical here. Iran's new proposal would see Iran halt its attacks in exchange for a lifting of the US naval blockade and, critically, a postponement of nuclear negotiations. Now, reports say President Trump discussed that offer with his national security team overnight. He didn't reject it outright, but he did question whether Iran is negotiating in good faith and whether Tehran is actually prepared to meet his core demand, which is ending uranium enrichment and committing to never build a nuclear weapon. Washington is expected to return with a counter-proposal in the coming days. Meanwhile, we're hearing more and more from the Gulf now, and in particular from the likes of Dr. Sultan Al Jaber, the UAE's industry minister, and the ADNOC Group CEO, weighing in directly on X again overnight, saying the Strait of Hormuz must open and be free of disruption. He said the free flow of energy and trade is essential to global stability and economic confidence. It was a short message but a pointed one, coming from one of the most influential voices in global energy, who knows more than anyone about the pressure on crude prices right now, with Brent back up to $110 a barrel, and of course the impact that we're seeing on shipping, insurance and global supply chains as well. His comments over the last few weeks really reflect how the region is increasingly unwilling to absorb the cost of a prolonged blockade, which is what this has turned into now 2 months into this conflict. And that frustration was also echoed in much sharper terms by the UAE diplomatic advisor Anwar Gargash, who was also speaking at a recent event in the UAE. Gargash describing Iran's missile and drone strikes on Gulf states as ferocious and premeditated. This is very strong language from a senior Emirati here. He said past Gulf efforts at mediation and trade with Tehran had failed, and he predicted decades of distrust ahead. Gargash as well has really been a lead voice from the region on what the day after plan looks like, and he's been warning of the danger that a nuclear-armed Iran would pose to the region as well. So I wanted to share that because put together, those two statements also paint a really clear picture here. The UAE, a key partner and a regional leader of the United States, certainly pushing on both fronts now. On the economic side, through Al Jaber, a call to protect global energy flows, and then on the strategic side, through Gargash, a warning that the Gulf is not going to forget what's happened over the last 2 months and will not be caught flat-footed once again. It's back over to you.
Dan, thank you very much for bringing us the coverage. Well, Ben has spoken with the former NATO Secretary-General and current Norwegian Finance Minister Jens Stoltenberg and asked for his assessment of the war in Iran and its economic impact.
In many ways, we are better off, meaning that we have had economic growth and we have invested in our sovereign wealth fund. But fundamentally, of course, Norway, it's in Norway's interest to have a peaceful and predictable world, and with conflicts going on and wars in the Middle East and Ukraine, that also has negative economic consequences for Norway. We are a small open economy. We export roughly half of what we produce in this country. And yes, maybe we'll have some increased oil and gas revenues because the oil price is going up. But on the other hand, other parts of our economy may suffer if exports go down because economic or global growth goes down. And we are now a big investor nation. We have saved all the oil and gas revenues and invested them in global stock markets. And of course, if stock markets are going down, it will also affect our sovereign wealth fund.